Imagine investing your hard-earned money today. You feel great, right? You're finally taking control of your financial destiny. But then, fast forward 5 years, and you discover that one simple, totally avoidable mistake has quietly cost you thousands of dollars. The truth is, most beginners don't lose their money because investing is inherently dangerous. No, they lose it because nobody taught them the rules before they started playing. Welcome to today's Explainer, where we're going to dive deep into the 5 critical investing mistakes almost every beginner makes, and more importantly, how you can sidestep them entirely to build real, lasting wealth. Make sure you stick around, because mistake number 1 is the absolute biggest reason people never build real wealth.
So it's a question that plagues pretty much anyone who first opens a brokerage account. Why exactly do most beginners lose their money? We usually assume it's because they aren't financial experts or math geniuses, right? But in reality, it almost always comes down to psychology. Our brains are actually hardwired in ways that make us terrible intuitive investors. Let's break that down.
Okay, the very first mental hurdle is just understanding the difference between saving and investing. Look, simply saving money in a basic bank account might feel incredibly safe. Your balance never goes down, sure, but there's a hidden thief in the room, and it's called inflation. Over time, inflation quietly erodes your purchasing power. That means your safe money actually buys you less and less in the future. Investing, on the other hand, is how you actively build and grow wealth. Yes, it involves inherent risks, and market values will fluctuate up and down. But historically speaking, investing is one of the single most powerful tools we have to outpace inflation and secure our financial future, as long as we manage those risks correctly.
Which brings us to mistake number 1, following the herd.
Here is where most beginners make an absolutely massive misstep. It's just human nature to look around and see what everyone else is doing with their money, right? This herd mentality perfectly explains the massive explosion of the meme stock. If you aren't familiar, a meme stock is an asset that experiences a massive, rapid jump in price and trading volume driven almost entirely by viral social media hype on places like Reddit or X, rather than the actual underlying health of the business. We famously saw this with companies like GameStop. Retail investors organized these viral campaigns, sending the stock price to the moon. People were buying in simply because everyone else was buying in, completely ignoring whether the company was actually making a profit or growing its revenues. When you contrast these two vastly different mindsets, the danger just becomes so obvious. With hype investing, your motivation is purely FOMO, the fear of missing out, or YOLO, you only live once. The risk there is extreme. It often leaves latecomers holding the bag when that viral excitement inevitably crashes. Compare that to fundamental investing. Here, the motivation is actual company growth and revenue. The risk is calculated. Listen, when you buy a meme stock, you aren't really investing. You're just hoping to find someone else to buy it from you at a higher price before the music stops.
And that leads perfectly into mistake number 2, trying to get rich quick.
This next mistake surprises almost everyone, honestly, because it stems from our totally natural desire to see immediate, massive gains. New investors tend to blindly extrapolate past returns. What does that mean? Well, if they see a stock that just skyrocketed over the last year, they assume it'll just keep climbing forever. They chase the recent winners. In the finance world, this reactive, return-chasing behavior is historically referred to as dumb money. It's a classic get-rich-quick trap where you end up buying at the absolute peak of the market right before the price violently corrects itself. When greed takes over like that, it's like money is just rapidly leaking from your wallet. Beginners fall into these traps by extrapolating recent high performance into the future, investing without any clear financial goals, and, perhaps worst of all, neglecting to build a 3 to 6 month emergency cash fund first. Seriously, if you don't have an emergency cash pot, what happens when your car breaks down or you lose your job? You are forced to sell your investments, often at a steep loss, just to cover your basic living expenses. Education and preparation absolutely must come before investing. Moving on to mistake number 3, zero portfolio diversification. Very few new investors actually understand diversification, yet it is literally the foundation of modern portfolio theory. Think about it like this. Putting all your money into one single stock, or even one single sector like just tech, is exactly like pulling a critical load-bearing block out of a balancing tower. If that one company has a bad earnings report, or if that one industry faces a sudden regulatory crackdown, your entire financial structure can come crashing down. Relying on a single investment creates immense, completely unnecessary structural risk. To mitigate that risk against localized economic downturns, you absolutely must spread your capital across different asset classes. You use stocks for growth, bonds for stability, real estate for income and inflation protection, and cash reserves for emergencies and opportunities. Each of these asset classes behaves differently in different market conditions. So when stocks are down, bonds might be up, acting as a sort of shock absorber for your overall wealth. All right, mistake number 4, emotional decision-making. To really understand this one, we have to look at the deep, complex psychology of how our brains process risk and reward. Traditional finance models just assume we are perfectly rational calculating machines, but behavioral economics proves that is completely false. We all suffer from a cognitive bias known as loss aversion. Humans are biologically wired to feel the psychological agony of a loss twice as intensely as we feel the joy of a comparable win. It's a neat evolutionary survival mechanism, sure, but it wreaks absolute havoc on our investment portfolios. Think about it this way. Gaining $100? That feels nice. It's a good day. But losing $100? That feels utterly devastating. It totally ruins your afternoon. Because of this extreme asymmetry in our emotional responses, beginners experience wild psychological turbulence. The moment their portfolio drops in value by even a tiny percentage, the pain is so acute that they instantly panic. And that panic triggers what behaviorists call action bias. When we feel anxious or fearful, we have this deeply ingrained, flawed tendency to want to just do something to regain control. We wrongly convince ourselves that taking action, like panic selling our investments at the absolute bottom of a market crash, is somehow better than just sitting on our hands and doing nothing. We sell low out of sheer fear, completely locking in our losses, when the smartest move is almost always to practice restraint and just wait for the market to recover. Finally, we arrive at mistake number 5, lacking investor patience. This right here is the ultimate mistake that quietly destroys long-term wealth accumulation for millions of people. Think of your investments like a growing tree. If it's planted early, given a little water, and simply left alone for a decade, it grows massive and strong. But if a nervous gardener constantly uproots it every few weeks to check the roots and see if it's growing fast enough, it dies. Withdrawing your investments too quickly due to short-term underperformance is exactly like that nervous gardener. You are totally interrupting the fundamental math of compound growth. There is a legendary quote from billionaire investor Warren Buffett that sums this up perfectly. He says, "The stock market is a device for transferring money from the impatient to the patient." It is such a profound truth. Successful investing requires looking past the daily noise of the news cycle. It requires thinking in decades, not in days or weeks. So let's look at some practical advice for beginners. Now that we've uncovered these hidden psychological traps, from following the herd to letting fear dictate our actions, how do we actually build financial stability moving forward? It comes down to following these simple, actionable rules to take back control of your financial destiny. Step 1. Learn before you invest. Never buy something you don't fully understand just because someone online told you to. Step 2. Build an emergency fund of 3 to 6 months of living expenses, so you're never forced to sell your investments in a panic. Step 3. Diversify your assets across different categories to structurally protect yourself. And step 4. Stay incredibly patient. Let time and compound interest do the heavy lifting for you. Thanks for joining today's Explainer. I really want you to take a hard, honest look at your own mental accounting today. Are you letting fear, greed, and the herd mentality dictate your financial future? Or are you ready to step back, diversify, and invest with the unshakable patience required to build real wealth? Ask yourself which mindset is truly driving your decisions and make the change today. See you next time.